everyone. Thank you for making the time and effort to join us this morning. It's much appreciated. I do realise it's not the most inspiring of seminar titles, so we might have to work a bit hard on that next time. But this is our winter tax update, which has been delayed from the spring due to circumstances beyond our control. So I'm the tax partner of Horson's in Sheffield office, and two of my colleagues, Aaron and Craig, are also going to be presenting this morning. So I'm going to start off. Could you have the next slide, please, Robert? And the next one. So yes, hopefully you know a little bit about Horson's. We're an independent firm of accountants with quite a strong focus on tax and other advisory services. So yeah, next slide, Robert. So this morning we're going to try and cover quite a lot of different topics to try and make sure that there's something of interest for everyone. Obviously, tax is quite a lot in the news at the moment. There's been reports being issued about capital gains tax and what should happen to that, but we're not really going to talk about those sort of things because they're all speculation and who knows what's going to happen. We're going to just try and focus on what we do know as far as we can say. I think what we can say about capital gains tax is that it's unlikely to go down in the near future. I think any change is going to be to increase it, but how far it's going to increase, I think, is just speculation at this point. Next slide, Robert. And the next one. So just to talk a little bit about capital allowances, I'm sure most of you know that capital allowances give tax relief for capital expenditure. It's not particularly generous capital allowances. It's normally at a rate of 18%, and for some things like long life assets and integral features, it's just at 6%. So the way to accelerate your tax relief is to take advantage of the annual investment allowance. This gives a full write-off in the year of expenditure of up to a particular threshold. So the default threshold is 200,000 limit, but for the past 2 years it's been set at £1 million. And the good news is the Chancellor's announced that will be extended for next year as well. So a good opportunity to invest in capital. It doesn't include cars, but most other items of plant will qualify. On cars, the situation's a little bit more bleak. As I mentioned, they don't qualify for the annual investment allowance. So generally, they just qualify for the 18% allowance. But if the emissions are more than 110 grams per kilometre, then they only go into the special rate pool and just get 6% capital allowances. If you've got a low emission car that's less than 50 grams, you get 100% first year allowance. So that's pretty good. The trouble is those rules are changing next April, and the threshold is changing from 110 grams to just 50 grams. So it's going to be quite difficult to get 18% relief on cars after April. The other problem is that the first year allowance, you'll have to be a zero emitting car rather than a 50 gram or less car. So it's going to be much more difficult to get those accelerated capital allowances on cars from next year. So a bit of a window of opportunity for the next 3 months of the first 3 months of 21. Next slide. So Craig put together a list of some of the cars which are zero emission. That's an expanding list, of course. And we do see quite a few owner-managed businesses, in particular. Business owner buys something like a Tesla, gets 100% capital allowances and a very low benefit in kind. So that can work really well. Next slide, please. If a business installs charging points at work for employees, then that's 100% first year allowance as well, and that's been extended. So that's another way of a business helping its green credentials, installing charging points. Structures and buildings allowances is quite an interesting one. It's been around a couple of years now, so it's introduced in 2018. but now we're starting to see some claims coming through the system. So it was originally a 2% annual allowance on new structures, but that's now been increased to 3% per annum. It's a little bit like the old industrial buildings allowance for those of you who with long memories. It's more generous in a way because it's all commercial property, not just industrial buildings. So offices would qualify, not residential, just commercial. You can include refurbishment costs. Slight complication is it's got to be the contract was signed after the 29th of October 2018. You only get it on the building, you don't get it on the land, and you don't get it on any items which qualify for capital allowances. One of the problems with industrial buildings allowance was that on a sale it got really complicated and quite complex rules around selling buildings. But this system is a much simpler system. The allowance just transfers to the buyer and they just carry on getting the 3% annual allowance for the life of the building. Next slide. So just a little bit on VAT, we've got a temporary reduced rate in the hospitality industry. Obviously at the time it sounded quite good, a 5% rate until March, but obviously a lot of hospitality businesses are just closed at the moment, so I'm not sure how much impact it's really having. But it is there. The flat rate scheme percentages have also reduced accordingly. And it's quite important to note that the business doesn't have to pass on the VAT saving to the customer. It can keep the saving by just keeping the VAT inclusive price the same. So that's useful. Another thing to watch is the reverse charge for construction. So that was scheduled to come in already, but it's been deferred till 1st of March. So basically in the construction industry, there's been a lot of businesses going missing owing VAT, and the reverse charge means that basically a business has to charge itself for that, a bit like the reverse charge for some international transactions. It's only the construction industry, but it will be quite a significant change for anyone working in that industry. So certainly something to take advice on, and our VAT consultant Tony would be happy to help with that if you've got any questions. Next slide. DAC 6, this is quite an interesting one. I think we've got some bankers and solicitors on the call, and they might well have been involved in this internal training and so on, because this is a requirement in the EU to disclose cross-border arrangements. So it only affects transactions which are cross-border involving an EU entity. So for example, UK to US, that could be caught, but US to Canada, that won't ever be caught. It will still apply after Brexit, so as far as we know, it's something that is going to be around for a while. And basically, if arrangements are designed to avoid tax or something similar, then they have to be reported. And there's quite a tight deadline, a 30-day reporting deadline. The rules have been deferred, so they're coming into effect on the 1st of January. But there is a look back, so any arrangements since 25th of June 2018 may need to be reported. And there's a whole series of hallmarks you have to review to check whether the reporting requirement is there. There's some pretty big penalties which can be charged up to £1 million. I mean, the revenue can't just impose a penalty of £1 million. They would have to go to a tribunal, but still, it is a significant issue. So something certainly to be aware of. But it's not just businesses, as I said, it's intermediaries as well. So that can involve, well, certainly solicitors, accountants, etc. So quite a wide-ranging issue. The next slide, please. I wanted to also mention about the Criminal Finances Act 2017. Obviously, this has been around for a little while now, but we are seeing some evidence of it. Certainly in corporate finance transactions, it's something which comes up on due diligence. The buyers are asking whether the target company has a has a policy in place regarding this bit of legislation. So basically, it's a corporate offence on companies or partnerships where they fail to prevent criminal tax evasion. Tax evasion could be in the UK or could be overseas, doesn't matter. And the way of protecting a business is to have reasonable prevention procedures in place. So that's really important that you have internal policies and training. Now, different businesses will have different risk profiles to this. So the starting point is to undertake a risk assessment and then make sure you have appropriate policies in place. I understand it's a strict liability. I'm not entirely sure what that means, but it seems to be that if you don't have a policy in place, then the revenue can impose penalties and you are in breach, basically. So it's all about having the policies and training in situation, and that should be done right at the highest level in the company. So the board of directors do need to sign off on it and make sure that's all in place. So something really to be aware of and make sure you've got those systems there. So I'm now going to hand over to Aaron, who's going to take you through some other corporate tax issues.
Good morning, everybody. Next slide, please, Robert. Okay, so just to give you a little bit of a context in relation to the items I'm just going to talk about now. A number of years ago, the OECD looked into ways that international tax systems could be harmonised in order to reduce base erosion and profit shifting. And as a result of that review, it recommended that tax authorities around the world implement a number of actions to reduce base erosion and profit shifting. And the corporate interest restriction was one of those recommendations. And the UK has introduced that into UK tax legislation with effect from the 1st of April 2017. The rules are pretty complex, but very broadly, under these rules, a group is able to deduct up to £2 million per annum of net interest expense. However, above that threshold, deductions for interest and certain other financing costs are capped at an amount equal to 30% of EBITDA plus any unused capacity for previous years. Okay, moving on to transfer pricing. The transfer pricing legislation has been around for many years, and basically it requires transactions between associated enterprises to be carried out on an arm's length basis. And enterprises must retain evidence of the transfer prices used and maintain sort of comparable data just to sort of justify the prices that they've used in that regard. However, where transactions are not carried out on an arm's length basis, the legislation requires that tax adjustments are made in the tax computations. And the legislation applies to intercompany supply of goods, services or assets, and also to intercompany funding arrangements and interest charges thereon. Small, medium-sized enterprises are exempt, and for these purposes, an SME is one with fewer than 250 employees, and either a turnover of up to 50 million euros or total assets of up to 43 million euros. And the transfer pricing rules was also something that the OECD looked at as part of their review, and they recommended that the rules were strengthened, and in that regard, they updated their guidelines, and those guidelines have now been enacted into UK law. I'm not going to go into detail regarding some of those changes because some of them are quite technical, but very broadly, the changes relate to the valuation of intangible assets, contractual arrangements where what's going on in reality isn't really reflected in the contract and things like that. So again, I'm not going to go into detail, but this sort of really serves as a reminder that companies, and particularly companies that are part of an international group, should really keep an eye on the transfer prices that are being used, applying appropriate markups, and maintaining evidence to support those prices used. And just a reminder, there are penalties for not complying. So if that's something that's of a concern to you, then please do get in touch with us. Okay, next slide, please, Robert. Okay, now moving on to the anti-hybrid rules. Again, this is a result of another action recommended by the OECD. Very broadly, these rules look at structures which exploit differences between the rules in different countries, where there's, say, a deduction by the payer of an expense in their tax jurisdiction, but the recipient is not taxed on that income in their jurisdiction. It also applies to double deductions for the same expense in two different jurisdictions. Again, the rules are very complex, but just to give you a very basic example of how these work. So for example, let's say company A is a UK subsidiary of a US company, and the company A pays interest on the loan to that US parent company. If the US company isn't taxed on that interest in the US, then the UK company is not able to claim a deduction for that interest in the UK, and would then have to add that interest back in its tax computation. Okay, country by country reporting. Again, this is something else that's come about as a result of the OECD review. And it applies to companies that are part of a group that has turnover in excess of 750 million euros. And the default position is that a UK company is required to submit a country by country report to HMRC, providing certain details of all companies within the worldwide group. However, if another company in the worldwide group is submitting a full CBC report to its local tax authority, for example, if the parent company was in Germany, then the parent company in Germany would be submitting the full CBC report. And in that case, the UK company is accepted from submitting a report. It just has to submit a basic notification just saying, we don't need to submit a full report because our parent company in Germany has done it. Okay, next slide, please, Robert. Okay, so moving away from the OECD recommendations onto R&D tax relief. Again, very generous relief. It's been around for around 20 years now. However, the HMRC statistics show that only about 4% of companies are claiming. And we think that a lot of companies are missing out on this. The relief is available to companies that aim to achieve an advance in science or technology through the resolution of uncertainty. There are two different schemes, one being the SME scheme, which is aimed at small, medium-sized enterprises, and the RDEX scheme, which is aimed at large companies, but it can also apply to SMEs that have got grant-funded or subsidised expenditure. And just to clarify, an SME is basically a company with less than 500 employees and a turnover of less than 100 million euros or balance sheet total of less than 86 million. So under the SME scheme, companies can claim 230% tax relief on qualifying costs. So if a company's got qualifying costs of 100,000, it gets an additional deduction of 130,000 from profits chargeable to corporation tax. And therefore, in effect, a company can save up to 43,000 for each £100,000 of qualifying spend. Where that claim creates a loss, the company can surrender that loss for a 14.5% cash tax credit. However, it should be noted that from April 21, that tax credit is going to be capped at 20k plus an amount equal to 3 times the PAYE and NIC liability. And the reason for that is that the revenue are looking at ways they can sort of combat some of the fraudulent claims that have been made, and that change as a result of that. And just to clarify, qualifying costs, cost of employees engaged in R&D, and so we'd be looking at bringing a portion of their salary, employer NI and employer pension contributions into account, consumable items, subcontractor costs, software, and externally provided workers. The RDEX scheme, as I mentioned, applies to large companies, but it also applies to SMEs that have grant-funded or subsidised expenditure. The relief is a lot less generous than the SME scheme and basically provides a 13% credit on qualifying costs, which is offset against the CT liability. However, that credit, that 13% credit, is taxed above the line, so the effective rate of relief is actually 10.53%. The time limit for R&D claims is 2 years from the end of the tax year. And this is just a very basic summary that I've done today, but if anyone wants any more detail on the scheme, we did a webinar a few weeks ago, which we recorded, and that's available on the Horson's YouTube channel. So if anyone wants a link for that, then please let us know. Next slide, please, Roberts. Okay, here's some more tax relief for companies that are engaged in innovation. Is the patent box tax relief. The relief gives an effective corporation tax rate of 10% on profits attributable to qualifying patents. And in that regard, the income could be received as royalties, or it could be embedded in the sales price of products. And a company must own a UK patent, UK or EU patent, or hold a license to exploit such a patent. And the company must have contributed to the development, as the qualifying patent box profits are now linked to the amount of R&D that the company has undertaken. Again, there's a quite convoluted calculation to go through to do this, but I think this is another potential relief that companies are missing out on. And again, if you're a company that's already doing R&D and claiming R&D tax relief, then have a think, is there any product or process that we can patent, and potentially, you know, get the 10% corporation tax rate and qualifying profits, just to maximise all of those reliefs that are being made available to companies that are engaged in innovation. And that sort of rounds off my section, and I'll pass over to my colleague Craig Walker. Thank you.
Good morning, everyone. So I'd like to start off by looking at personal tax changes, and then finish off today with a few changes to employment tax. So first of all, looking at recent tax changes affecting property landlords and also homeowners, and starting off with mortgage interest relief. So it used to be possible to deduct, for a landlord to deduct all of their mortgage interest costs when calculating their taxable rental profits. But the government thought this was too generous and decided back in 2015 that it would make some changes to the rules. And these changes have been phased in over a 3-year period. So it's only now in the 2020-21 tax year that we're seeing the full impact of these changes. So now it's no longer possible to claim, to deduct the mortgage interest when calculating the rental profits. And instead, what we do is claim a tax credit equal to 20% of the mortgage interest when calculating the tax that's due. So the calculation has completely changed, really, and this will affect high earners, and this will affect those with very high interest costs. It's important to note that it only affects residential properties. So if you have a commercial property, you will not be affected by these changes. Also, it doesn't affect furnished holiday lets, and quite interestingly, it doesn't apply to companies. So we've had lots of inquiries from landlords saying, well, should I just incorporate my property portfolio? Is that the right thing to do? And the answer is no, not necessarily. It can be the right thing to do. It can offer significant tax savings, but it's certainly not the right thing for everyone to do. And there can be some downsides to incorporating, particularly if you have an existing property portfolio. It could trigger capital gains tax charges and also stamp duty. So it needs to be reviewed on a case-by-case basis, really. Moving on to capital gains tax. And in April this year, we saw a very significant change to the capital gains tax regime. So we're looking here at disposals of residential property in the UK. This doesn't apply to any overseas property. And now there is a requirement to submit a tax return to HMRC and pay any capital gains tax within 30 days of completion. So previously, it was possible to have up to 22 months before the return was due and before the tax was due. Now you've got just 30 days from completion. So quite a significant change to the regime. And if you fail to submit the return, then there are penalties. It's a £100 initial penalty, and then subsequent penalties of 5% of the tax due, which could obviously be quite significant, and then further penalties of £10 a day. So the penalties can soon rack up. Thankfully, these rules do not apply to the sale of your main residence. So provided the gain is covered entirely by private residence relief, you do not need to submit a return. And also, if you make a capital loss on the sale of a residential property, then again, there is no requirement to submit a return within 30 days. I should just flag up that if you are a non-UK resident landlord or property owner, in fact, then there are separate rules that apply. So it's a completely separate reporting regime for non-UK resident individual companies. From April 21, we will see a change to the stamp duty land tax rates for non-resident property owners. The aim of this change is to make house prices more affordable in the UK for UK resident individuals. So non-resident individuals will see a 2% surcharge applied when purchasing UK residential property. That kicks in April next year. And the money raised from this new rule will be used to tackle rough sleeping, we're told. So I think this is very much aimed at the London housing market and the South East, really. Next slide, please, Rob. So back in July, we saw a very significant announcement to do with stamp duty land tax. The Chancellor announced that there would be an 8-month temporary cut in stamp duty land tax. But this was done with the intention of stimulating the property market in the UK, and it seems to have had quite an impact. Conveyancers seem to be pretty busy at the moment, I understand. So this came in on the 8th of July, and it's due to run until the 31st of March. And what it means is that if you buy a home worth less than £500,000 between those dates, you will pay absolutely no SDLT, because the SDLT threshold has been raised from the usual threshold of 125,000 up to £500,000. So there are some very significant savings to be made here. I think the average saving is supposedly £4,500. That's what the government tells us. But the maximum saving that you can achieve is as high as £15,000 from this temporary cut. So yeah, potentially some very big savings. It only applies to the purchase of residential property, so not commercial property, and it replaces the special SDLT rules that apply to first-time buyers. Also, interestingly, the cut also applies to the purchase of second homes and buy-to-lets. I think when the announcement first, when this was first announced, there was some confusion about whether landlords would be able to benefit from this SDLT cut, but yes, they can. However, there is still this 3% surcharge that applies to additional homes. So if you are buying a second home or a buy-to-let, you will pay an extra 3% SDLT. So you can see from the table at the bottom of the slide, just on the right-hand side there, the rates that would apply if you were buying an additional home. But still, significant savings to be made if you do purchase that property before the end of March. And obviously, who knows, it may be extended beyond the end of March. We'll have to wait and see on that one. Next slide, please, Rob. Moving on to private residence relief. So in April 2020, we saw a change to the rules. So it used to be the case that the final 18 months of ownership always qualified for private residence relief, as long as the property has been your main home at some point. But the government thought this was too generous, so it's decided to change that exemption from 18 months down to just 9 months. It doesn't apply in all cases, so in some cases it's still possible to claim for the final 36 months, but very limited circumstances. So we're looking there at people moving into care homes or the disabled, so it's now generally 9 months. And it used to be possible to claim lettings relief if you sold a property that had previously been your main home and then was let for a period, and that could lead to quite a significant tax saving. But the government has decided to largely abolish lettings relief, so now it will only apply if the owner is in shared occupancy with the tenant, which is very, very rare that we see that. Moving on to entrepreneurs relief. So prior prior to the budget, there was a lot of speculation about what might happen with entrepreneurs' relief. Would it be kept? Would it be scrapped? And in the government's manifesto, it promised to review and reform entrepreneurs' relief. Well, the Chancellor decided to keep entrepreneurs' relief, but a significant change was made in terms of the lifetime limit. This was reduced from £10 million down to just £1 million. So obviously the Chancellor thought this was too generous prior to March and decided to reduce it. So what we've seen with entrepreneurs' relief is that when it was first introduced back in 2008, we had a lifetime limit of £1 million. It's subsequently gone up to as high as 10 million, and now it's back down to just 1 million. So really, we've gone full circle really with entrepreneurs' relief. And not only have we gone full circle, but we've now got a different name for it. So from March 2020, we should now be calling it business asset disposal relief rather than entrepreneurs' relief, which I suspect might take a bit of getting used to. We're all familiar with calling it entrepreneurs' relief. And just one thing to flag up as well, obviously with the lifetime limit reducing to just £1 million, it's important that we try to double up the allowance where we can. So perhaps by passing some shares to a spouse, making sure the spouse owns more than 5% of the company, and making the spouse an officer or employee of the company, just to try and maximise the use of the lifetime limit. Next slide, please, Rob. Just very briefly, in terms of pension relief. So looking here at the tax relief that's available on personal pension contributions. I don't want to get into the technical detail of it, but in general, an individual can pay up to £40,000 into a pension each year and receive tax relief, receive income tax relief on those contributions. However, if they are a high earner, then the standard annual allowance of £40,000 is reduced. And it used to be that if your adjusted income was over £150,000, then you would see a reduction to the annual allowance. Quite interestingly, and it was quite a surprise really in the budget that it was decided to increase that threshold from £150,000 up to £240,000. So an increase of 90,000 for that threshold. And also the other change that we saw back in the March budget was that the minimum allowance that was previously £10,000, that was going to be reduced down to £4,000. So if your adjusted income is over £300,000, then unfortunately the most that you can pay into a pension and receive tax relief is just £4,000 a year. So the rules relating to this are quite complicated. So if you're in this category, or you need any advice in relation to pension contributions, then please speak to your pension advisor, or speak to an advisor from Horston's Wealth Management about what you're able to contribute. Because the last thing you want to do is to pay in too much and then face a tax charge. Next slide, please, Rob. So moving on to employment tax issues now. Next slide, please, Rob. Thank you. So first of all, looking at company cars, and I guess it's bad news and good news really for company car users. So just to recap, the company car benefit in kind is calculated based on the list price of the vehicle when new, and also the CO2 emissions of the vehicle. And it used to be the case that the CO2 emissions were based on something called the NEDC method. The government has realised that there's another method called the WLTP, which stands for the Worldwide Harmonised Light Vehicles Test Procedure. And this method is meant to be meant to give more realistic results, really, in terms of emission figures. But you won't be surprised to know it actually gives a lot higher figures as well. So on average, 20 to 25% higher figures under the WLT method compared to the NEDC method. So how does this impact on company cars? Well, if you buy a company car now, so if you buy one registered after April 2020, the emissions figure will be based on this new test, this WLTP method. So you'll probably pay more tax than you did previously, because the WLT method gives these higher emissions figures. There is a 2-year transition period to try and soften the blow of this new method. So that will apply for the next 2 years. So that's the bad news, I suppose, for company car users. The good news is that if you have a fully electric car with 0 emissions, then you will pay 0 benefit in kind tax in this current tax year. You'll pay some next year. You'll pay 1% and then 2% in the following year. But clearly, you're going to be paying very little tax for the next 3 years on that company car. So that's quite a significant change, really. If we look back to last year, if you had a 0 emission car last year, you would pay tax at 16% on the list price. So gone from 16% down to 0. So clearly, the government is trying to encourage companies to buy 0 emission vehicles. And similarly with company vans, they're wanting to encourage companies to buy 0 emission vans rather than polluting vans. So from April next year, if you're provided with a company van and that it is a 0 emission van, then there will be no benefit in kind. And they do exist. I've looked, and they do exist. You can get them. There's quite a wide range of manufacturers of 0 emission vans. And in terms of company vans, there's been a very interesting case this last year regarding Coca-Cola, and it could have very significant ramifications for users of double cab pickups and company vans. So what happened with the Coca-Cola case is that Coca-Cola provided its technicians with Vauxhall Vivaro vans and also VW Transporter combi vans. So I actually hired a Vauxhall Vivaro last year when I was moving house. It's definitely a van. It's a good size, and if you saw it in the street, you'd say it's a van. But the government, or I should say the HMRC, decided that it should be taxed not as a van but as a car, and that's because Coca-Cola had made some modifications to their vans, and they'd put a second row of seats into the back of the van. The seats could be easily removed, but still, the HMRC thought that because of this extra row of seats, it should be taxed as a car rather than a van. So quite a surprising result, really. So whether it's taxed as a car or a van, it really depends on whether the vehicle is primarily suited for conveying goods. So if it's primarily suited for conveying goods, it's a van, and it should be taxed as a van. But the Court of Appeal found that the vans that Coca-Cola were providing were actually multi-purpose vehicles. They could be used for carrying goods, but quite equally, they could be used for transporting people as well. So very interesting case. We're yet to see whether Coca-Cola will take it to the Supreme Court. They do have the option of appealing to the Supreme Court. So I think within the next few months we should see some updated guidance from HMRC regarding this case and the wider ramifications. But yeah, very, very interesting case. Next slide, please, Rob. Just finally, just want to mention a couple of other issues on employment tax. So IR35, this is the reform of the off-payroll working rules. So back in 2017, the government reformed the rules in the public sector, and that led to a big increase in the amount of tax it was receiving. So naturally, the government wanted to roll out this reform to the private sector. The plan was to do this from April 2020, but then obviously we had COVID, so the government decided to postpone the rollout of these rules to the public sector until next April. Sorry, to the private sector until next April. So it is still happening. It's just being delayed by 12 months. And it's important to flag up that these changes only affect large and medium-sized businesses. it doesn't affect small businesses. So the government predicts that 95% of businesses will be unaffected by this change. So what's a small business? So if your turnover is less than 10.2 million, or your balance sheet total is less than 5.1 million, or you have less than 50 employees, then you're likely to be treated as a small business. So it's important to check the rules, really, check the criteria, and see where you fall, and see whether you need to change your systems going forward. And just finally, in terms of the employment allowance, this was introduced back in 2014, and it was introduced at a rate of £2,000. We've recently seen this increase to £4,000, but with some restrictions. So it's now only available, well, it's aimed at the smaller end of employers, really. So the government's keen to avoid the likes of Tesco receiving this employment allowance. So it's only available to employers with an annual NIC liability of less than £100,000. So this allows certain businesses who employ workers to reduce their annual NIC liability. Next slide, please, Rob. So that concludes what we were wanting to talk about today. But we do have some time for questions. So hopefully some questions have come in whilst we've been chatting through the chat box. So we'll do our best to answer some of those now. And obviously, if we don't get time to answer them today, then feel free to contact us at a later time. Our contact details are up on the screen there, so feel free to get in touch with us.
Yeah, thank you, Craig. I forgot to say at the beginning that we'd have time for some questions and answers, so apologies for that. But yeah, if you've got any questions, then feel free to ask them or put them into the chat box, or as Craig said, just email us separately. We've just got one question come in, just asking whether we think there'll be harmonisation between income and capital gains tax rates. So that was the suggestion in the Office of Tax Simplification's report recently, that income tax and capital gains tax should be aligned. So that would push in capital gains tax up to 40 or 45%. So obviously it's possible, all things are possible, but it does seem very harsh, particularly for business owners. Business owners always had a lower rate of capital gains tax, whether that was retirement relief or entrepreneurs relief or business asset disposal relief, to reflect the risks they're bearing. So you'd think there'd be some sort of relief, whether that's business asset disposal relief continuing, even if standard capital gains tax rates go up. And I think also there'd need to be some sort of indexation allowance as well, which we had back in the day, to reflect, the inflation increase of, property and so on, to actually strip out the real profit. Don't know if you guys got any questions, any thoughts on that, Aaron or Craig?
I think I agree with you, Stephen. There's got to be some incentive for people that are taking risks and investing in businesses. But I agree that obviously you'd have to have some form of indexation in there to strip out the inflationary element. Yeah.
We've had a question come in relating to what used to be entrepreneurs relief and what is now business asset disposal relief. So they're asking whether the £1 million lifetime allowance, whether that relates to the tax or the gain. So that relates to the gain rather than the tax. So yeah, just to clarify, the £1 million lifetime limit is the gain.
Okay, well, unless anyone's got a burning question, then I think we'll probably wrap it up. But as I said, happy to take questions separately outside this forum. So thank you so much for joining us this morning. And if you've got any feedback or anything, then please just let us know, and look forward to seeing you in the future. All right. Thanks very much.
Thanks everyone. Cheers.